Thank you, Penny. And yeah, good morning, everyone. Thank you for joining today. As Penny said, my name is James Chaplin. I'm the Senior Manager of Curve Trading here at EDF in the UK. And plan for this webinar is pretty much the same kind of setup as usual. Kind of look at kind of the market price review, looking at mainly gas pricing, talk through some of the gas fundamentals, touch on geopolitics, wrap up with a bit of a summary, and then obviously open up for questions. So if you do have any questions, feel free to post them throughout the webinar, and we'll try to answer as many as possible at the end. So if we start by looking at kind of a few kind of gas contracts, this is from the start of this winter, so start of October or so onwards, and you can say we'll get to the right hand side of the chart where I'm sure a lot of people's eyes are being drawn to. A lot of movement and kind of excitement in the market to start this year with fundamentals changing. But if we cast our mind back to the beginning of winter, and I suppose actually just to explain the chart, in the yellow line we have the Feb 26 gas contract. In the blue line, we've got the summer 26, and in the green line, we've got the winter 26. So it's just different kind of forward products. And I'll explain kind of why. See, the front is moving a lot more than the curve a bit later on. But cast our minds back to beginning of winter, so start of October. Now, this kind of spike, I suppose, doesn't look very, very spiky on this chart due to kind of the recent movements, but was quite a big move up at the time. What we really had here was Russia starting regular strikes on Ukraine gas production, so significant capacity taken offline at the time. There was concern around how long that capacity was going to be offline. Actually, quite a lot of it was brought back on fairly soon after. But overall, it did mean Ukraine had to increase imports from the EU, and that's kind of continued throughout winter. So that was the first bit kind of tightening balances for Europe this winter. And I'll probably reference kind of balances quite a lot in this presentation. What I mean by that is really looking at gas supply and demand, how they kind of level off against each other, and that's referring to gas storage as well. So looser balances, got more supply than demand. Gas storage, easily fills up in summer, ready for winters. Tighter, obviously, drains gas storage a lot more. At that time as well, we did have some early signs of cold weather, which actually didn't end up materializing, but came into the forecast before coming out again. Now, the market is always very susceptible to kind of market moves, price moves in October. As beginning of winter, that really sets the tone. If you get a cold start to the winter, you're thinking, oh, you've got a long time to go before you kind of get to milder summer months and demand drops off. So it really kind of sets the tone. A bit later in October and into November, we did start to see prices ease off a little bit. Now, we did have some cooler weather forecasts, nothing too drastic, so no real cold snap, just a few degrees or so below normal going into November. But that was really offset by continued strong LNG imports. And again, nothing really too concerning going on around the globe in terms of supply demand as well. We then get in to kind of back end of December time, and we actually saw a big adjustment in temperature forecast. So back end of we were expected to get seasonal, if not actually slightly below seasonal temperatures for the first week or two of December. The forecast change over the weekend actually saw a strong Atlantic jet influence going to come in, so bringing milder air into Europe. So temperature forecast actually jumped up by around 4 or 5 degrees forecast on forecast. So it flipped it from slightly below normal forecast to actually quite a mild forecast. And this lasted around 3 weeks. So mild weather for quite a significant portion of time, obviously reducing demand by quite a bit. At the time as well, we had hopes of a peace deal between Russia and Ukraine. So Trump was pushing for peace before Christmas. We all know now that didn't materialize. But obviously that raised kind of hopes that Russian gas would then return to the market and obviously ease balances quite significantly. But this mild weather happening in December again is quite important. Typically, as I said, early winter kind of dictates what happens to pricing or so and how comfortable the market sees it. If you get mild into December, everyone's thinking, right, unless we get severe cold in Jan or so, we should get through winter quite easily, and then refilling gas storage should be a lot easier as well. Going into the back end of December, so around kind of this running up to Christmas week or so, where the forecast did start to turn cold. So that mild spell that lasted around 3 weeks came to an end. The Atlantic jet influence came to an end, and we got some slightly colder temperatures for Europe. So again, just depleting gas stocks a bit faster than expected. Nothing to really worry the market at that time. But obviously, it just was, again, a first step of starting to tighten balance a little bit more. People's end of season storage carry-out forecasts were slightly reducing. Then we come into 2026, and you can see obviously massive increase in pricing. Now, this has impacted more the near curve, so your kind of prompt February, March contracts really rocketed up, as you can see in kind of that yellow line. Curve contracts less so, so you have seen an increase in both the summer and winter 26, and particularly a tightening of that spread, because refilling in summer is actually going to be a lot harder now, and I'll explain in a few slides' time. The FAR curve, which I don't have on this chart, so summer 27 onwards, has actually fallen so far this year, just because the long-term forecast of more LNG supply, looser markets, still kind of holds past 2026. So really, the concern is more short-term. Obviously, that can filter through depending on how severe it gets. But what's happened, what's actually driven this increase? Well, we've had cold across all the main global gas demand hubs. So the US, Europe, and Asia, significant cold. EU's been mainly cold in kind of northeast since kind of that, Christmas a week or so, just before Christmas week. And it's forecast to be cold over the next few weeks as well. We also have an increased threat of an SSW event, and I'll explain what I mean by that in a few slides' time. And we've had some rising geopolitical risks as well, which again, I'll touch on. The one point missing from this, which we've also seen, is a lot of kind of hedge funds coming in to the new year had short positions. So they actually flipped short kind of back end of December. So that aided to that big sell-off, the market probably getting a bit ahead of itself. And they entered short. Obviously, when the fundamentals flipped to bullish due to the cold weather, they've had to get out their positions. So that we've seen several kind of short squeezes, we call it. So people being forced to buy to close out their positionings. So if we start to look at some of the fundamentals kind of driving this, so European gas storage chart, which we usually look at in this webinar. So you've got several years worth of data here. If we concentrate on this red line, so you can see from April 2025, obviously we injected at a fairly good rate. Now, we didn't get to the high levels at the start of winter that we saw in previous years. Now, this was probably, again, the market getting too comfortable too early. Really, we had the opportunity to put more in storage into Q3, but I think storage assets didn't really want to fill up too much, with the expectation that the market's going to get a lot looser with all the LNG supply coming in, and therefore they'd have more expensive gas trapped in their storage, unable to obviously sell at a profit. So the market fundamentals at the time dictated that they didn't want to fill to such high levels. The red line you can see kind of flattened off, so that's that. Not really any cold snaps through kind of October into kind of beginning of November. But since then, we have seen quite strong storage withdrawals down to where we are now, which is significantly below this time last year. Now, the grey kind of shaded area, you might think, we're not too low now, but obviously that low before was pre-Russia-Ukraine conflict, and where we were getting stable Russian pipeline gas into Europe. So the point where we're at now, as of the 24th of Jan, 45.6%. If I updated that for 2 days now, so as of the 26th, we'd be at 44%. Our end of January forecast sees us getting down to around 41%. So that's at the back end of this week. And our end of March forecast, and obviously this will be very much dictatable on what weather fundamentals we get, how severe kind of cold snaps are, and any supply side changes as well. But current forecasts see that getting to sub 25%. If we did get obviously more severe cold and SSW, which we will see in a few slides' time, that could get below 20% or even lower. Now, either way, it is forecast to get to potential record low gas storage numbers. First of all, it puts us at risk of a late cold snap in kind of March or April time. I don't think we'll see a situation where we'll run out of gas, but again, the market might get concerned at periods going forward for that. But what it really means now is filling up next summer or this summer. will be harder than previously expected. So at the beginning of winter, everyone was thinking our end of March storage forecast was going to be around 35%. So you can see that's significantly lower than expected. We're going to need more gas to fill up storage this summer, and we might then risk going into next winter at slightly lower gas storage stocks. So one to watch, obviously going to be very dictated on what happens with the weather over the next few weeks. US gas production, now this isn't so much of an issue now as it's kind of recovering, but what we see here is kind of US gas production over the last few years. Kind of the orange line is this year. You can see that big drop off. That is freeze offs happening, so impacting supply and therefore kind of LNG exports to Europe. But you can see that severe Arctic cold over that map I've just posted there, getting quite southern into kind of Texas. So concern that it would obviously impact US balances, impact the ability for them to export gas, but also we have seen some LNG diverted actually into New York as well. Obviously, the eastern states demand ramping up in the cold snap they're having. So again, this should be short-lived. The reason the market's coming off over the last couple of days is because we're getting confidence this supply is coming back. So it's not any long-term impact. I suppose the market was worried what happened back in 2021, I believe, when again they got a bit more severe Arctic cold, and therefore we had, I think Freeport, one of the LNG terminals, was actually offline for several months because of some damage caused by the severe cold there. So something to watch, but I don't think it kind of seems to have passed for now without too much long-term impact. Now, zonal winds, so possible SSW event. SSW is sudden stratospheric warming. I best like to describe this as, if you think kind of the zonal winds around the North Pole as kind of it's a spinning top. So the faster these zonal winds go, the cold Arctic air is trapped in the north point of the globe. So it's very kind of stable as the faster it goes. When these zonal winds break down, and when it goes below zero and therefore reverses direction, that's what's called an SSW event, so sudden stratospheric warming. And there's two types of these events that can happen. So first of all is a displacement. So that's when that cold air mass stays essentially as one and then gets displaced off the North Pole. So then that can obviously come down to demand areas, so you can get your severe Arctic cold in, say, Europe, for instance. Or you can have a split, which is the more severe of the two. And that's when the cold air mass splits in two and kind of again moves off the point there. Now, the rule of thumb with this is if we do get an SSW event, depending on how severe it is, there could be a 2 to 3 week lag of the SSW event happening and potential very cold to hit Europe. Now, it doesn't mean 100% cold for Europe because it could mean cold elsewhere and actually we get a bit milder, but it increases the chance quite significantly for severe cold, severe Arctic cold and easterly winds into kind of UK, Germany and such. So not definite it's going to happen. I think they're putting the risk around 70% at the moment. And of that 70%, it is leaning towards more of a split, the more severe one, around 65, 70% of that as well. If I just plot on here, hopefully you can see that dotted line that's just appeared. Now, this is one of the previous years. This was 2017 into 2018. And you can see it's roughly similar trend we're following. We're getting a potential SSW event around mid-February. Now, the reason I'm bringing this up, not to scare people, just to kind of give a flavor of what the market might be concerned around at the moment. This is 2018, so when we got beasts from the east and obviously that severe cold then. So again, not definite going to happen, just something the market, and I'm sure many people want to just keep an eye on. It could lead to potential severe cold back end of Feb, early March, if it does occur. But again, even if we get an SSW, we need to see how severe it is and also where around the globe it'll impact overall. Temperature, not too much to say on this one. Overall, I suppose mild temperatures through kind of October, November, December, as we said, turned cold kind of around Christmas, and then Jan is where January data so far is when we're starting to see the cold. Now that is focused more kind of northeast of Europe. We've got a very strong Scandi block system, so the cold air kind of blocking any influence from the mild Atlantic jet stream. So Germany's been very below normal, same with the UK, and the forecast over the next couple of weeks, I think into week 7, so week commencing the 9th of Feb, that Scandi block is expected to expand and bring us more cold in February as well. So this kind of pattern we're seeing where it's kind of this big kind of cold air mass northeast versus kind of mild impacting kind of like Spain, Italy, and kind of the southern countries is expected to continue. It's really kind of where this boundary of cold and mild really meets. But at the moment, we are seeing cold risk over the next few weeks, and obviously you tack onto that any SSW events that could happen. Some good news, I suppose, and all of that's not all kind of doom and gloom and kind of tightness. Global LNG exports, so you can see 2026 outline. They will continue to pump out more. So more projects, particularly in the US, have come online. Plaquemines keeps on producing over nameplate capacity and has put in a request to actually uplift their capacity numbers going through this year. So lots more LNG supply, which is good, which should be kind of bearish for markets, obviously, if it wasn't for the demand side increase. I suppose one of the concerns we have is some of the big Qatari projects due to come online. They were supposed to come online around now. They got pushed back until Q3 or Q4 this year. Again, just keep an eye on them. If they get delayed significantly anymore, that could tighten winter a little bit. But overall, LNG exports, particularly from the US, are very good at the moment. Now, geopolitics, we thought coming in to this year, it was going to be a much quieter time, both in kind of markets volatility due to fundamentals and that increase in LNG we've seen kind of reducing prices, reducing volatility. And we thought kind of geopolitics was going to see calm down. We had a big spike back in last June. That's not really been the case. So 3 kind of things to follow. First of all, we had Venezuela impact. So to me, it didn't really impact UK power and gas market so much. So not really one to be concerned of, but it shows kind of how and anything kind of Trump can do can kind of rock markets a little bit. So that one less so. Obviously, it does increase risk of more operations happening in different countries, but nothing impacting global supply there. Next is Russia-Ukraine peace talks. So obviously, we had the big push before Christmas. That didn't materialize to anything. They have had their first trilateral meeting, so Russia, the US, and Ukraine. So this weekend just gone. I think they've got another follow-up meeting this Sunday. Again, it looks unlikely they're going to have a big breakthrough. Russia sticking to their demands at the current state. But obviously, that is the biggest bearish risk to the market. So if there is a breakthrough in peace talks, there can be relaxation of US sanctions, although I wouldn't expect that to happen fast. They'll wait for, see how the kind of the peace agreements filtering out before kind of relaxation sanctions and obviously increasing that supply to the globe. But still one of those possibilities. On the flip side, very low chance, but you could have more sanctions. But I'd say more looking like biggest bearish price risk at the moment if they do manage to come to some agreement there. The biggest one to watch out for at the moment is obviously what's happening in the Middle East. So obviously the US and Trump has kind of built up forces around the Middle East, and we could see escalation. So I think both Iran and the US are carrying out military drills, exercises in the region. Obviously, if we do get escalation there, Iran could threaten to close off the Strait of Hormuz, which would significantly impact global oil and gas pricing. I don't think any country wants to see that happen. So again, very low chance, but you could see news stories which drive volatility to the market. And I suppose this one is more kind of upside, at least short-term upside price risk if something does happen there. But again, obviously Trump is aiming to make a deal if the two sides can get together and kind of talk. So overall, obviously this year has been a big kind of bullish drive in UK gas pricing. So added significant premium to both power and gas prices. One thing I haven't also touched on, but carbon pricing has been bullish as well. So we're kind of moving towards linking the EU and the UK schemes, which has been supporting UK pricing as well as European carbon pricing being bullish due to tightness anyway. But geopolitical risks obviously still remain in either direction. So going forward, weather fundamentals, I think will just continue to dictate price direction. We've had simultaneous cold snaps across the three big demand hubs. Obviously, what happens in the EU over the next few weeks, if we get that SSW event, that's going to be really key in seeing where we end this winter in gas storage and how much pressure does that put on refilling in the summer. We're not in the same situation we were a few years ago where, energy crisis times, we were worried about depleting stocks to zero and we won't be able to fill up. Global LNG imports are much higher now, so should alleviate some of the concerns there. But it does mean obviously we'll have to stay at a certain price level to attract the LNG to fill up our more depleted stocks. Russia-Ukraine peace talks obviously continuing. They provide the biggest downside price risk, as I said. See, any breakthrough in talks could lead to relaxation of sanctions on Russian gas. That might be slow to materialize, so won't impact global balances immediately. And then you do have the outside chance of further sanctions. The Graham bill has proceeded, which would be give Trump the power to put on bigger sanctions. But again, he doesn't seem to be moving in that direction at this current time, but who knows what he's thinking. And then escalation in the Middle East obviously provides big upside price risk. Again, nobody wants to see the Strait of Hormuz shut. But yeah, we saw this last June where, escalations have kind of ratcheted up prices in the market, and then the quick de-escalation after the US struck some of the nuclear facilities in Iran, and then the prices came off quite sharply. Again, any headlines could drive some volatility there. And lastly, obviously looking ahead, I think the long-term view still looks set. Obviously, we've got, as we saw, lots of LNG coming online over the last year. Good LNG output so far this year. We're expecting the US projects to continue to ramp up and then get the Qatari projects online a bit later this year as well. We do have some risks to that. Overall, much more supply coming online this year and next year should kind of ease balances. And that is why this price rise has been really contained to the next few months and obviously lifting slightly this summer and winter 26. But your contracts further out, so the 27s, 28s on the gas at least have actually moved down. On the power, I'd probably see kind of like limited movement just because you've had that bearish gas offset by the bullish carbon. And that is all from me. I'm sure there's lots of other details to go through, but hopefully a good whistle-stop tour of the markets at this current time.
Thank you, James. Yes, definitely a very interesting, insightful whistle-stop tour. So thank you. We'll go to the floor now and see if we've got any questions. There was one that came through earlier, so apologies if you've kind of covered it. But it's, how do you see the European gas storage levels beyond this winter, the summer replenishment and Win 26 prices, bearing in mind that we are receiving plenty of US LNG?
Yeah, so it'll all depend on how low we get at the end of this winter. So obviously depend on the weather. As I said, it's not in a situation like the energy crisis where, we're going to really struggle to fill up. There's lots of LNG online, so bar anything drastic happening to supply side over the next couple of months, we should be able to fill up to a good level. But it's, what sort of percentage stock levels are we going to be comfortable going into next winter for? So yeah, you could see elevated prices for the summer and winter 26, just to be able to attract the LNG and be able to fill up storages, but you're not going to, at this current time, it's not going to be kind of energy crisis sort of levels or concern.
Okay, thank you. The next one we've got is, so Europe was too reliant on Russian gas. Now US LNG. What are the chances that Trump uses this as leverage?
Probably low, but who knows? I think that was kind of one of the concerns around the Greenland row did spark concern of could Trump use that as leverage to get his hands on Greenland. But it's low. I don't think the US would move that way. But obviously Trump is very unpredictable. I think you just got to keep an eye on things. So it put very low chance to it, but we'll see what happens.
Thank you. We'll watch the Trump space. Another question, though, I think this is one for another, but I'll read out. So, as non-commodity costs have increased sharply, are there any planned increases coming for gas non-commodity charges?
Yeah, not one for this webinar, but I think there is a monitor webinar on the 18th of March, I believe. So they should be able to answer that in a much better way than I could.
That's what I thought. Thank you. Yeah. So yeah, there is. So if you head over to our website on the TalkPower events page, there is monitor non-energy costs explained. So we'll be able to answer that for you there. Thanks. Okay, we've got a few more coming in. So what about GB gas storage?
Yeah, UK gas storage is quite limited. Obviously, Rough was our only kind of long-term storage site, which is kind of obviously hasn't been really utilised, shutting down at the moment. So it's really just what we call MRS, so medium-term storage. They can move fast, so they can inject and withdraw quite rapidly. If they were in net withdrawals mode, we would empty out the storage within 10 days. So yeah, it's not really something we, to keep an eye on in terms of long-term balance expectations. That's why we kind of refer to EU storage, because it's the long-term storage sites with a lot of capacity. UK just kind of helps us out in times of, peak days of demand and short cold snaps. If we did get a prolonged cold snap, 2 weeks or so, we could see some more kind of country effects in the UK, where UK has to price a lot higher to get imports from continental Europe. But yeah, we just don't really have the storage capacity like Europe does. Not the same anyway.
Thanks, James. Next question. Our price forecast indicates rates reducing. Is this reliable?
I can't really comment without seeing the data. Obviously, what we showed earlier was obviously a lot of the price increases have been contained to the front. So, your February, March contracts have really spiked, whereas your summer, winter 26, they have gone up this year, but they are still on the gas side. They're still below where we were a few months ago. So again, it will all come down to the comparison. But yeah, if you're looking at your price comparison of the summer, winter 26, so your 12-month contract out of April versus a few months ago, you're probably not going to see drastic amount of difference. And then again, if it's a longer term contract, so going out into the 27s, again, their movement has been pretty flat, I would say, over that time. So more of the concern, more of the uplift more recently is in the front. So if you're looking at contracts out from April, you won't, I don't know, again, depends on the timeline, you wouldn't have seen such a drastic increase like we saw in the charts earlier.
Thank you. How likely are the 10% US tariffs over Greenland to make a tit for tat that we impose import tariffs on US LNG, making refueling more expensive?
Not too sure. We have to see kind of what happens in the political space. I don't think, I think it's kind of the Trump's move. He threatens tariffs, and then he kind of backs down from it, and there's more talks. It's not to say there's going to be more escalation and he's going to threaten more tariffs. I think how we see the market impact there is, if the US threatens more tariffs, it just puts some economic concerns then on the EU, and therefore lower growth, lower demand growth. But yeah, I think we'll have to see. I don't expect anything escalating there too much. He's got a lot on his plate elsewhere than picking fights with Europe at the moment.
That might answer this next question. Another Trump one. So, can Trump reduce LNG exports to Europe, considering all the investments done in LNG infrastructure recently?
He can do, but I don't think that will happen really. Obviously, it's very profitable for the US to send their gas to Europe, and they need buyers for it. That is the long term, strategic goal, is to increase the LNG exports and obviously make money out of it. And Trump is a businessman, so yeah, there might be threats. There might cause short term volatility, but I would personally be quite surprised if they actually reduced any LNG exports at all.
Yeah, that's positive then. So why has the UK moved away from gas storage? Appears to be another example of short-sightedness.
Yeah, I suppose that's just been the plan for a number of years now. Yeah, as we said, rough storage was the only kind of long-term storage site, and that was started to close down several years ago. And there's just not been any investment into larger storage sites. It's more investments into interconnectors, and then linking ourselves with continental Europe a bit more. But obviously, that comes with our own risks. And obviously, we've invested in more LNG supply, so it does kind of increase UK risk for long-term cold snaps. 2 weeks or so, which would get through our storage, but then you still have imports from Conti you can rely on. So maybe a bit of short-sightedness, but yeah, it's not cheap to obviously build kind of these big storage sites and maintain them.
Thank you. So we've got a renewables question now. So do you see oncoming renewables supply having any significant impact on the market yet?
Yeah, we have done over the last few years. So first of all, in the forward markets, you can see clean spark spreads have turned negative. So if you go back a few years ago, you'd be looking at a winter clean spark spread of positive £5, and now you're looking at maybe like negative £5. So that's that increase in renewables has helped decorrelate kind of the direct link between gas and power. Just because there'll be some periods where you've got a load of renewable generation, you don't need much gas running at all. Still, in our high demand periods, we do. So that is kind of the link we see in kind of the forward contracts. So the clean sparks reduce. So you've seen a good kind of decorrelation between gas and power there. Now, in the prompt, obviously, higher renewables is going to drive more volatility. On high renewables days, you're going to see very low pricing and potentially more negative hours this summer. And then when it's lower renewables, you're going to have much higher pricing as well. And you'll particularly see that in the summer, potentially in kind of the block 6. So you might have, say, high wind and solar over kind of your peak time of the day. So that will depress your block 4 pricing. But then obviously your demand ramps up into the evening. You need your gas stations to turn on from cold and for a short period run. And that's a lot more expensive than previously what they're doing years ago, which is running for warm starts for longer durations. So yeah, a lot more intraday volatility, and that can be day to day, depending on renewables forecast, but also intraday between half hours and blocks. So I suppose yeah, good on kind of the forward horizon. It has decreased power pricing relative to gas, but yeah, lots more volatility in the prompt market. Obviously, what the one concern, not concern, question we have is with the ramp up of battery capacity in the UK, when does that help alleviate some of that intraday volatility?
Thanks, James. Right, we've got a few more questions that have just come in. I'm just having a little scout through, see if there's any related, but I think let's have a look what we've got next. So, is there a lot of hedge fund exposure which could affect prices later this year, or is it still early stages and not too impactful?
Still early stages. There is a report that comes out every Wednesday, which actually shows you the hedge fund positioning, the COTAS, the Commitment to Traders report. And yeah, that will show you their hedge fund positioning as of the Friday before, so slight delay. But yeah, what we saw, say like this time last year, where hedge funds were very, very long, they then flipped short, as I said, kind of back end of November, December time last year. And obviously then coming in this year, they've now gone long again. So they've been one of the big buyers in the market. Obviously, probably a lot of them getting stopped out because the prices moved massively against them. Yeah, it definitely worth keeping an eye on kind of their positionings going forward, because it can drive volatility, especially if they're kind of caught out with market fundamentals changing. But yeah, that is all publicly available data every Wednesday.
Okay, so maybe a link we could share if I could get hold of that, perhaps with the comms that goes out. So you say it's something that is public.
Yeah.
Yeah.
So a report that comes out just shows their positioning. Obviously, we don't know what they're going to do, later this year. I mean, we have seen a lot more fund action in this current market, they like volatility. So versus say 5 years ago, a lot more funds are participating in European gas markets. So yeah, that can drive bigger price volatility extremes as well.
Thank you. What have we got next? So, with the current market volatility, are you seeing any impact on GB market liquidity in years 1, 2 to 3?
Nothing nothing drastic at the moment. Obviously, like depending intraday on how volatile it is. So you could say, several days this year, you have lower volatility, you have wider bid-offer spreads just because market participants are staying out, just because there's so much uncertainty around fundamentals. There's not much confidence for people to put on kind of big positions and tighten those bid-offer spreads. So yeah, you could say at times over the last few weeks, liquidity has been impacted. On a longer term trend. Liquidity is still fairly decent, but yeah, the volatility makes some participants kind of stay out of the market. But obviously EDF, we're depending, regardless of how much trade in the market, we'll always provide quotes to kind of our customers who will never not provide liquidity.
Thank you. So we've probably got time for two more questions. I think we only have two more questions there, so that's perfect. So let's have a look what we've got. So there was lots of noise Q1 and Q3 about gas storage needing to be 90%, which was reduced down to 83%. It would appear that some EU countries did not make it to the 83% target. If there are no consequences, why was the concern driving prices in early 2025?
Yeah, so I mean, the rules were beginning of last year, 90%, as you say, and that's what drove the summer winter price inverting last year. So the summer gas price in Europe going big premium over the winter, which obviously doesn't make sense for storage stocks. There's no economic sense to fill up at a more expensive price than you're going to withdraw. And therefore, with that kind of market movement, the EU Commission brought in kind of a lower gas storage fill rate, again considering the longer term fundamentals of more LNG supply coming online. So yeah, storage sites were just not incentivized to really fill. And if you think you're a single storage player, you don't really want to fill loads this summer, not be able to withdraw it this winter, and then the longer term view was weaker prices, so you have a lot of more expensive gas trapped in your storage site. So yeah, I think it kind of made sense for the Commission reducing the storage, the minimum storage fill capacity. I think you should let the market just be the market, let the prices dictate how you should fill up. But yeah, obviously some storage sites, particularly Germany, didn't fill up nearly enough as they should. And although what we showed earlier, EU storage as a whole is at 44%, I think Germany and one other country already sub 40. So there could be some, if it does get more tightness going forwards, there could be some different kind of price spreads between countries depending on how full their own storage sites are.
Okay, thanks, James. And then our last question. So now the European Union has approved a complete ban on Russian gas imports with a phased implementation set to conclude by 2027. When do you expect to see this ban having an impact of prices, or do you think this is going to be limited given the lower reliance the EU now has on Russian gas?
Yeah, the market should rebalance itself. It's not stopping out Russian supply. That Russian supply can still go elsewhere to buyers in China, India, or anywhere else in Asia or so. And there's enough time. If it was like if news broke and it was an immediate ban, then you would have a short-term kind of volatility price uplift. As it's all kind of planned in, it gives the market time to readjust. And there's enough spare LNG kind of freight capacity, so tankers to do the longer trips that it will take to go to other demand hubs. I think one of the key things is, are they going to ban like flows through Turk Stream, which I don't think they'll do. There'll be kind of legal loopholes, I reckon, through that. So probably not too much a concern to the market at the moment. The market will rebalance itself without too much trouble.
Brilliant. Thank you so much. That was really, really insightful. We had loads of questions. So yeah, lots going on. It's a wild market, like you say. So I guess we'll just wrap up by advertising our next webinar for you, which is monitor report non-energy costs. So if you want to come along and ask any questions around what's going on in the non-energy costs environment, that's a good one to sign up to. If you want to get in touch about anything else, our email address is at the bottom. Let's talk power at edfenergy.com. And if you don't already, follow our LinkedIn page because we're regularly keeping updates on there and promoting our webinars and things. So I guess that's it for them for today. Thank you so much, James. James will be back on the 29th of April. So you can also register for the next Power Market Updates webinar at the same time if you need to. We'll wrap it up there. Thanks.
Thanks all. Cheers. Bye.